Welcome back to the Advisor View podcast. I'm Josh Heil, CEO of Citizen Mint, and today I'm joined by Jacob Talley at Prospero Wealth. Thanks for joining us, Jacob.
Yeah, thanks, Josh. It's great to be here.
So maybe you can start us and talk about your background and your path into wealth management.
Yeah, I'd be happy to. So my first job out of college was actually at Fidelity Investments, placing client trades in a call center. So in a way, I started in this industry. I took a long detour and kind of came full circle. I'll spare the details of the detour, but just say that several years after my MBA, my wife, who I had met in grad school, she and I moved to Seattle because she's from the area. And I kind of hit reset on my career, which had been focused on corporate finance up until that point. And starting in 2014, I then spent 10 years working at VC-backed startups, mostly on the consumer side of things. And what I learned at those startups is that I really love building. There's nothing better than going from 0 to 1 kind of alongside a high-performing team.
Yeah.
Right. Like, especially when there's real camaraderie and you're kind of sharing a vision. And so it was a lot of fun. But, in 2024, after 10 years of startups, a couple different ones and no big exits, I was kind of asking myself like whether I had another decade of that in me. And I felt like I did, but that energy needed to be directed into something more of my own. And I realized it didn't need to be a business with $1 trillion TAM, or something that was going to 100x every year.
Yeah.
And so, I wanted something more durable, long term and kind of personal. And I was also at a stage in life, and I know a lot of my peers were and are too, where, the personal finance questions were becoming more difficult, right? I think you accumulate wealth up to a certain point. And then the questions start to become more difficult, right? Like it's like, should the next dollar go into my retirement account? What if I want to be work optional early? How do I become more tax efficient now that I'm entering my peak earning years? And researching those questions and working through them kind of made me realize like that's really what I wanted to do as a career. It's really what I had wanted to do all along. And so, the kind of like the proverbial, the best time to plant a tree was 20 years ago. The next best time is now, right? So,
And so how do you find Prospero and like your relationship with Eric, who runs it?
I mean, very, very fortuitous, kind of serendipitous. So I made this decision that I wanted to pursue this as a career, right? But what I was unsure of was kind of like the how. I was like, do I do this like totally solo, go out on my own, like never really having done this before? And there's a lot of, that's way more feasible today than it was 10 years ago. There's lots of good, you got XYPN, a lot of good platforms and companies and materials out there. But I also knew I'd really benefit if I could find an established RIA that I could work with, right? That was kind of aligned, who'd give me kind of what I needed from an autonomy standpoint and things like that. The question was like, could I find that fit?
Yeah.
And so, I'm like doing all my homework. I'm perusing like subreddits and listening to Kits's podcast, right?
Yeah.
And so this was late 2024. I'd kind of decided to go out on my own because I hadn't found a good fit.
Yeah.
And I hear Eric Franklin on the Kitsis podcast. Here's this guy, career switcher here in Seattle area. I was like, I'm just going to reach out to this guy, like tell him how much I appreciated his podcast and kind of bounce some ideas off of him. And he was like, hey, yeah, we should grab coffee. And kind of one thing led to another. And he was like, I want to expand the Prospero Wealth practice. I'm trying to bring advisors on board. I think you'd be a great fit. And learned a little bit more about kind of what his vision was. And it just felt like a good fit. And I'm immensely thankful that things worked out the way they did, because now that I'm like, a year or two into it, I'm like, I don't know, like it sped up the education and the ramping so much. Like there's so many things I didn't have to figure out on my own because Eric had kind of gone through a lot of those learning curves. So
yeah, no, definitely having somebody do that and like understand like where not to do, or even like building a tech stack for a wealth management firm is incredibly challenging.
Yeah, building the tech stack and cultivating the relationships, right? Like,
Yeah.
I mean, we'll get more into it, but it's kind of like, here's a given strategy, right? Whether it's long, short, or custom indexing, or whatever the case may be. And there's all these different providers, right? And products and services. It's like, how do you know which one to like work with, or what the pros and cons of each of them are?
Yeah.
And he had done a lot of that homework. And so it just made things so much easier.
Yeah, definitely. What about just how your kind of former career leads into like how you go about your business? So being, tech startup employee, kind of like, and I know Eric has a big background on the Amazon side. And just how does that also lead to who you really focus on? And maybe you can talk about your focus areas of like clients.
Yeah. And so, I mean, we focus on kind of mostly tech and to a lesser extent, kind of with my background, startup employees. It's kind of like a Venn diagram that overlaps pretty heavily, right? And what they have in common is, heavily equity comp focused.
Yeah.
And with that equity comp comes complexity and kind of uncertainty from the client side. And so the honest answer of why is kind of like, it's just because that's who we are, right? That's where our relationships and our credibility, exists and already lives. And so I think that's sort of the surface level answer, but I think the deeper thing behind it is kind of like, I think a lot of tech employees are really skeptical of financial advisors.
Yeah.
All of us were as well, like when we, sitting on the other side. And so I think that kind of gives us a level of kind of credibility, and having sat in the shoes of a lot of our clients, it just helps us build rapport and gives us a little bit deeper credibility with them, right? So we've sat through vesting cliffs and layoffs and all sorts of like tech changes and things like that, and we know the mechanics of equity comp. And so I think that's the big thing on the client side, but it also candidly kind of affects how we run our firm too, right? In terms of operations. So you mentioned like tech stack, and I think we've been through like 3 AI note takers in 2 years. We're always, kind of thinking through like what are the best products and services we should be using, like what's best in class. And we really think about it like a product team would think about their tech stack in in any other organization. So so there's that piece. And then also just, we've branded our process Agile Financial Planning. So anyone that's worked with an engineering, or you're familiar with, Agile planning and tech sprints and things like that. So, we're less about delivering this big 40-page financial plan, and more like, what are the 3 to 5 most important things that we can be working on? And let's just kind of like knock those out piece by piece, right?
Yeah. Yeah. What about just how, and maybe this is a part of what you just said about the agile planning, but how Prospero approaches wealth management differently and approaches clients differently. And, you mentioned RSUs and just all the equity comp, and maybe that's like really a huge differentiation, which I think it is, because that can be incredibly different across companies and how people get paid.
Yeah, I mean, so do you mean more of like the
I mean, how are you going to market and saying, hey, versus these other 5 wealth managers you might be talking to or thinking about, here's how we're gonna like work with you differently?
Yeah, so I think, on one hand, the good planning is kind of the same everywhere, right? Like, what are the client's goals, and what are the best vehicles and strategies to get you to those goals or achieve those goals? And so I think any good advisor starts that way. I think the difference is really kind of on the inputs. Equity compensation arrives as like all these vests on a calendar. And a good generalist, like advisors kind of exist on a spectrum, right? Like a good generalist might be able to build a plan for that, but maybe tech clients aren't really the bulk of their book. And so for us, they are. And I think that familiarity compounds a lot, right? And so it's familiarity with the tools that one uses for equity comp, whether it's we've mentioned long short, custom indexing, exchange funds, 351 exchanges, list goes on. But we have familiarity with that. And then I think from the goals side of things, there's a difference too, right? Because a lot of our clients are not necessarily planning to work until age 65. Maybe they are just for personal reasons, but they want to be work optional, or maybe want to take a sabbatical. And if you're sitting on a lot of fast growing tech wealth, or really healthy portfolio, you might be work optional years before that. And it raises these other questions of like, how do you fund health insurance for 5-10 years before Medicare, or what accounts do you draw from, right? Like these types of clients that we work with just have different problems, where it's like, if you're not used to working with a lot of these kinds of clients, you're just not going to be as familiar with those strategies. And so I think, a big part of our positioning is just like a familiarity with these strategies. We've used them. We have lots of clients that use them. And I kind of touched on this a little bit before, but it goes back to some of the partners and providers we work with, right? Of like, we're not just like scrambling, like, hey, let's figure out how to do long short. It's like, here's 3 different long short managers that we could set up SMAs with. Here's when and why you would want to use each of those, right? Like, because they each have pros and cons, perhaps. And so I think that's another part of our positioning of like how we do things differently. It's like, not just like, here's the strategy. It's like being able to speak to it at a little bit deeper level of authority. So
And how are you all going about, finding those clients? Like, what's kind of the main strategy? Is it referrals? Is it, going to tech conferences? How do you actually like find these individuals?
Yeah. So this is where I've had a lot of fun, because my background in startups included several roles kind of more on the marketing side and digital marketing side. And obviously, the world's changing so fast with AI. I mean, the bulk of our referrals and clients has largely come from our networks, right? Our team, which is I think 6 advisors now, we all have this kind of like career switcher background, generally speaking. So we all have deep networks in these different firms. So that's been helpful. But where I think we've started to get a lot of traction now is building out content on our website. I'm really trying to think about like, AI engine optimization, AEO, and things like this to drive traffic. And we've had some really good success in those areas. Doing things like these podcasts and talking to people like you. I think one of the things you really see on the marketing side is, I think PR is going through kind of like a renaissance almost, of like, because everyone's focused on LLM citations, like, the way you get that is through, external placement, right? And PR can be a great way to do that. We've had some good success there too.
Interesting. Yeah, that's so. And that would be from a geographic perspective. That means that it's going to go beyond the Seattle area and go beyond, like, more geographically the whole U.S.
Yeah, exactly. I mean, that's one of the big, I think, strengths of, like, we're 100% virtual firm. We don't have a physical office. And we have advisors kind of spread up and down the West Coast. So we have a West Coast bias, unsurprisingly, just given our client focus, right? But we are 100% virtual, so that makes things really easy. And our clients like that too, right? I think, especially post-COVID, most people don't want to have to, drag their butt to the financial advisor office and sit there through a presentation. So
no, definitely. Maybe you can just talk, and I think this will be interesting to a lot of the listeners, but just managing a concentrated stock position for your client and how you think about like risk, taxes, discussion. Because even what I've seen in the past when I've been working with clients, and especially like tech clients, who we had a lot of like, and this goes back a while, but we had a lot of early Microsoft employees, and they were so attached to that position within the company. And so how do you detach them from that position to be like, let's take risk off the table?
Yeah. I mean, this is such a hard question that is so unique to each client, right? And it's kind of like you've got the easy part is kind of like the destination. Like, here's the model portfolio. Here's where we want to get you to. And then it's kind of like there's lots of ways to skin a cat and get there.
Yeah.
And so, so what are the client's goals, right? So I've got a client, he's got a lot of RSUs with Amazon, and in his case, right, like he's got a home renovation or home purchase he wants to make for his family. Like that creates a liquidity need that would be very different than a client in the exact same situation that doesn't have that same liquidity need, right? And so, goals, risk tolerance. I think risk tolerance is a funny one too, because it's like you could have two clients at the same company and they sit in different departments and they could have totally different outlooks, right?
On the company.
On the company's prospects, right? So it's kind of like if you're at Amazon again, like in your like on the maybe the marketplace side, that could be totally different than if you're an engineer on the AI side, like right? And so which isn't to say, you want to take those factors into account, but it's which is to say their unique perspective on the risk, but the questions are the same, right? Let's think through the behavioral kind of, what if the stock goes up 50%, down 50%? How are you going to feel? One of the nice things I think is behavioral finance has come so far along now. It's kind of well established, right? Like the loss aversion, the feelings of loss are much stronger than the feelings of gains and things like that, right? And so, thinking, but again, like to bring it full circle, like it's kind of like there's not a one size fits all. We talk through these things, and it's kind of like, what are the goals? What are the different levers we have to pull, and how do we get there?
What about just navigating the differences, and like how do you work through that with clients? And I'm thinking about differences of like maybe you can, because this is a broader audience, like what's an RSU versus an ISO versus an NSO, and like liquidity events, and how do you navigate those differently?
So it's changed, like even just in the time I've been doing this, what's changed is candidly like the client side and in LLMs and AI, right? So I think before, because it is so complex and there are so many different tools, I think it behooves us as advisors, we have to go a lot deeper, right? In modeling these things out, like, because it's not as simple as just like, hey, here are options A, B, and C, and D, and we're recommending option A, right? The client wants to model out, and especially our clients, they're gonna, if we don't model it out and kind of show them, they're gonna go do it on their own. They're gonna bring it back to us and be like, why did you choose this?
Yeah.
And so, for RSUs, it's kind of like, well, what's the best calendar look like, and how often is that happening, and what does it look like based on top of their other compensation and tax brackets and future expectations about how or whether those things potentially change. So, it might be like you've got this big concentrated position. We can afford to just hedge what you have, sell future RSUs as they vest. And that's kind of how we'll go forward. That would be very different than someone who's maybe pre-IPO at one of these, whether it's SpaceX or Anthropic or whatever, and that position's like 80% of their net worth, right? Like, those are two very different scenarios. So, we've done this now enough that I think we've seen, kind of, model scenarios, right? Whether it is that big IPO coming up, or whether it's someone sitting at a more established company doing RSUs. Like those are the two. I feel like RSUs are pretty common now. Like the general tech industry is kind of settled on that largely as like the primary vehicle of equity compensation. But we do see some really early employees at some of these startups that have QSBS and ISOs, incentive stock options, and things like that come into play. And those have their own playbooks too. So I think we have kind of established playbooks for each of these scenarios, but it's just a matter of kind of like walking clients through the tax implications, because the clients, it's very easy to look at things pre-tax and say this strategy seems most advantageous. What's a lot more difficult is what is the after-tax impact, especially as it relates to other portfolio options, right?
Yeah.
So if there's money or liquidity to be deployed in some other strategy, it might be able, it complicates and might be favorable to the overall tax picture. Whether that is a private investment, whether that's, again, tax-aware long short and harvesting losses, each of those things can affect the overall tax picture. So to get back to the question of like how it's really just, it's modeling out scenarios for clients and making it personal and unique to their situation to show them what that can look like.
Yeah. And what mistakes do you often see that create maybe unnecessary tax bills?
Yeah, I don't think there's not any one thing. I think what we generally see is kind of a lack of conviction, again, of what that after-tax picture looks like. So, but I guess if I was going to pick two places where I see things bite the hardest, like first is on RSU withholding, right? So supplemental income, like an RSU vest, is typically withheld at 22% federal until you cross, the threshold of $1 million, and it just jumps to 37. And so a lot of tech employees live in that in between of, depending on what their marginal rate is and things like that. And so, especially if RSUs are kind of new to them, that can often come with a surprising tax bill. And then the second we kind of touched on is ISOs, and that calls into question like AMT, alternative minimum tax. And so that can be a big one too. I mean, right now the AMT threshold's a lot higher than it used to be in years past. So it's not quite as much of an issue, but it still can be, especially if you're at one of these firms that with really high growth trajectory. So both of those ISOs with their holding periods and really specific timing with the exercises and holding, you want to make sure you're not going to mess those up and get yourself into a tax problem. So
what about maybe you kind of touched on this, but like just that behavioral bias of really getting to the client and being like, hey, you're going to actually need to sell some of this stock, and even if the company is going parabolic, it's like, hey, you should probably be taking chips off the table. Like, what does that conversation start like?
So I think one of the questions I like to ask, because again, it's usually RSUs. And so it's kind of like RSUs is really just cash comp in stock form, right? And so if you were to ask a client, like, if those RSUs had actually been issued all in cash, would you have taken all that cash and put all of it and bought stock in your employer, right? Like, probably not. You would have allocated some percentage of it maybe to that to your employer stock, or more likely maybe to the sector as a whole, even if it's like the Qs or something like that. And so it's kind of like, what is the right ratio to hold that? Again, a lot of our clients have built their wealth on the backs of a single stock and a single concentrated position, right? So you don't want to, my role is not to come in and be like, oh my gosh, you have way too much. We need to like sell all this over the next like couple years because this is way too risky. I actually think our firm is much more understanding of that desire to hold that upside. But yeah, I mean, we want to let our clients, continue to have some of that upside. It's more about like what fits for you, and let's have rules in place for like, whether it's, tracking some moving average or percent of net worth or some combination of that. Like, let's agree on rules up front and thresholds so that we, don't find ourselves trying to make a emotional panic driven decision in the future. So
what about just thinking about private markets, your client's interest in private markets? Obviously they have concentration, sometimes in a private stock, sometimes in a public stock. How do you think about that and where that fits into a portfolio for some of your clients?
Yeah, so I'm gonna get really nerdy and wonky here, but
Yeah.
I actually take it all the way back to like modern portfolio theory and
Yeah.
capital asset pricing model, right?
Yeah.
And the CAPM portfolio is never the S&P 500 or even all public equities.
Yeah.
It was built around the idea of a basket of all the investable assets in the universe, right? And a significant share of investable assets are private. And
Yeah.
so on pure theory, kind
It's
of
actually gotten bigger too,
right.
which
Yeah, the share
because
of private as the overall
yeah,
has only gotten bigger, right? And
yeah,
we've definitely seen this in the States as like the number of public stocks has declined.
yeah.
Um,
These
and
companies have
so,
stayed longer, private longer.
yeah, exactly. And so I think on pure theory, like there's a place for private markets in a portfolio, all else being equal, right? Now, the other part of that, like all else
Yeah.
being equal is doing a lot of work in that statement, right?
Yeah.
Because the same theory is built around like no transaction costs, no taxes,
Yeah.
all these things,
Yeah.
right? And so that's where the work comes in, is because in practice, like for a lot of private investments, like fees might be higher, the structures can vary very widely.
Yeah.
There's often investment minimums, and so it becomes a real conversation once a client crosses a certain level of wealth, because
Yeah.
you want the position to be small enough that illiquidity or a total loss doesn't move the entire plan, right? And so minimums can set a floor for kind of like what that can be or how much it can look like, right? Because if the minimum's like 100K and that's like 10% of their portfolio, that's very different
Yeah.
than if it's 1% of their portfolio, right?
Yeah.
So I think all those factors come into play. And then again, just the diligence burden is a little bit different, because
Yeah.
obviously public stocks are not all the same, but they are standardized and kind of like there's a price, dividend, well-known ratios, trading mechanics, like liquidity profile is generally the same. And with private assets, that's just not the case, right? So every deal has its own structure, its own fee stack, liquidity terms, and it's not a reason to avoid it. It's just like the selection matters a lot more, like in a very different way. And all these intricacies better than I do, right? And then you got private equity and versus private credit. And so I think the lack of standardization is something that a lot of clients and prospects maybe don't fully appreciate. They think like, okay, yeah, I want a slice of my portfolio in privates. It's like, okay, why? Like, say more. Like, to what extent? Is it just to have that as part of your portfolio? Is there a specific like sector you're thinking you need exposure to? Let's talk through that. So, I mean, to get back, kind of bring it full circle, like, yeah, there's a place for privates in the portfolio 100%. It's just kind of like we want to make sure that, tail not wagging the dog, that sort of a thing. So.
Sorry.
No, all good.
Yeah. So, and then that totally makes sense. And I think that's actually this question I start with when we talking to like some of our clients. We're like, hey, what are you actually trying to achieve here for your clients? Is it some level of diversification? Is it growth? Is it a replacement for something else in their portfolio that or like, and usually we try to find like, non-correlated assets that are very differentiated from what they're going to get elsewhere. And that's like really the goal, is to reduce that volatility for clients, to not make behavioral errors when the markets turn over, which is really an incredible value that an advisor usually provides. It's like, we're here to make you so that when the markets go down 30%, you're going to not start doing stuff that's going to like really impair your financial future. Yeah. So.
Yep, 100%. Yeah, and again, every client's different, but it's kind of like if they have, it might be they want passive income or something like that, or there's passive income in the functional sense of like interest and dividends. But some of them actually maybe have passive income and from a tax sense, and it's kind of like if there are certain investments truly generating passive income, like maybe there's private opportunities that in real estate that could offset that, or right, and things like that. And that's a totally different opportunity and picture. So
and I think that's we can get into this as kind of the next topic, but I think that's where the industry is going, is this, instead of like, hey, you're just a 50-50 allocation, like 50% like equities, 50% fixed income, or a 60-40 or a 70-30, which is traditionally how people have done it. It's more personalization to the client's very specific financial goals and their liquidity needs, which I guess that kind of goes into like, where do you think the industry's headed over the next 3 to 5 years? How is AI going to play like a huge portion of that? So,
yeah, I mean, that's a really like, I'll take it in the bite-sized pieces, and we can like get really maybe more broad and you know, but I'd like to piggyback on what you were talking about of like matching, asset liability matching, right?
Exactly.
Or goals and asset matching. It's kind of like, I think up until really recently, all the focus has largely been in this world has largely been on investment allocation and 60-40, 70-30, 80-20. And I put just as much focus for clients on like your tax location, right? Like what is your between tax deferred, tax free, like, you know, you're kind of like Roth HSA stuff versus taxable brokerage accounts. Like what does that ratio look like? Because I think there's a lot of value in having diversification even amongst those different kind of like tax locations, because you know, who knows what the tax rate profile picture looks like in 10 years after whatever legal political changes, right? And so having diversified tax locations matters too, right? And you know, kind of going back to the like, are you hoping to maybe retire early, right? Like if so, like a common thing we see is like, yeah, I want to be able to retire early. And then you look at their portfolio and it's all in a tax deferred 401k. And it's like, you know, well, I have some, you know, good news and bad news. Like good news, you sucked away a lot of savings and retirement investments. Bad news is you're going to be paying a penalty if you try to access any of that before 59 and a half, right? In most cases. And so it's like, all right, you know, this is going to seem counterintuitive, but we actually kind of need to build assets up that are taxable potentially, right? Or look at Roth conversions or things like that. And that's like where the value add is of like doing planning and, you know, having done this for clients before and things like that. But you can kind of, it's almost like, you know, it's just another aspect of lifestyle design, right? It's kind of like, where do you want to be? And do you want to move to a low tax state? Or, you know, if you retire, maybe you just don't work for a year or two, and then we can do some Roth conversions. And, you know, oh, you want to live abroad? Well, here's how that complicates your tax situation, right? And these countries are going to tax ETFs like this, or, you know, whatever the case may be. So AI can, so I don't know, I could pause there and then we could pontificate about like how AI is or might change it. But like, that was kind of, I wanted to build on kind of what you were referencing there, like this goal and asset and allocation matching. I do think that personalization, level of personalization is like where everything is moving.
Because I think that's what clients expect. It's like, they're like, I'm going to pay you, I want it personalized to my specific situation and just not be in another bucket across your firm.
Exactly. And I think, you know, yes, that's what they're looking for. That's the real value add, because I mean, it's been the case for a while now. If all you want is the investment allocation, like robo advisors, things like that are, you know, can do that piece pretty well. Like the part that can't really be out of the box standardized is that customization and matching it to your goals and understanding you. And I think that is an area where like AI is kind of changing the game, but even then, you know, it's still so sycophantic and inclined to tell you what you want to hear. And I've even had this kind of with some client engagements where it's like, where we're going back and forth on recommendations, and they're coming back with questions to me that I can tell are very much driven by an LLM. And, you know, and they're perfectly legitimate questions, but, you know, maybe skepticism about the recommendation and proposal of like, well, why not this, right? Or what about this? And I'm like, that's certainly an option on the table. Like, here's the pros and cons of that and why I didn't recommend this, right? And
Yeah.
bringing up issues maybe that their LLM didn't think to surface or want to surface, right?
Yeah.
It ran maybe counter to their narrative or where the chat was going, right?
Yeah.
And so, yeah, I know it's a new world. It's a fun one, but
Yeah.
you know,
Yeah. Okay. And maybe just to kind of like close this out, because I always like to ask this question. So what's one thing that people don't know about you, or one hobby that you have?
ooh, okay. So I'm probably the only person in America who's smoked a Japanese A5 Wagyu brisket twice. So
Okay, tell me more.
So one of my startup stops was at a company called Crowd Cow, where I was like the first full-time employee. I joined Joe and Ethan there, and Crowd Cow started off all about sourcing meat from small independent farms and ranches and making it available, like, ship it straight to your door, right? And so my first job there was like going to find these farms and ranches and setting up the supply chain and all that. And we then added on Japanese Wagyu. So one of our co-founders, Joe, he spoke Japanese, like went to Japan and cultivated some of these relationships with some of the Japanese Wagyu producers and companies. And so we sourced like Japanese Wagyu, and so I got to do all these like photo shoots and eat all this Japanese Wagyu beef. Like there was a point in time I was probably eating, I don't know, like more Japanese Wagyu than anyone else in America. It was just like crazy. But what the market didn't have was like, you could always get the like strip loin or ribeye or filet, right? Like the kind of popular, call them like the Hollywood cuts that you'll find on any steakhouse. But you can't really find Japanese Wagyu in these other cuts, right? And so I'm from Texas, and so I'm all about like smoking meat and brisket and stuff. And I was like, we should try to source Japanese Wagyu briskets. And we did, and we,
And why is that? Why can't you source that specific? Like, what do they use that for? Like hamburgers, or what are they?
Yeah, it comes down to the fact that like meat is so different by country, right? In terms of like how they value these different cuts.
Yes.
And so the general thinking is that like an American would never pay X dollars per pound for these briskets. And so like so people just don't do it. And then the other aspect of it is kind of like the way they prep it and cut it. Cause like if you look at, if you go to like a butcher shop, you'll see the little cow diagram, and it's like, here's the way they break it down. Like that's also different for like country to country, right? How they break a cow down. And so in Japan, what's kind of funny, so we imported some of these briskets, and this is a special type of Wagyu called olive Wagyu, which I could go on about. But these briskets, Josh, were like 30 to 40 pounds. Like for our American listeners, if you've not bought a brisket before, a Packer brisket is going to run generally like 10 to 15 pounds. Like, like once you're getting like 14, 15, 16, that's pretty big Packer brisket. These were like 30 pounds, sometimes bigger. And that's just because, like, again, the way they broke it down, it was much bigger than just like what we do. And so it was a whole thing actually in terms of like,
I mean, that's a lot of brisket to cook at once.
Oh yeah, no, it's a lot. Yeah, it's a lot. And I mean, it was delicious. No regrets. I could never have afforded to have bought one of those briskets myself, but getting to do it and create the content for the company was a lot of fun. So
that's incredible.
Yeah.
Well, that's a good way to end it. That is the most unique one I've had. So here we go. Well, thank you so much for the time, and really appreciate all the conversation. Super interesting. I mean, like on the tech side of things, it's just incredible. Like that, it's such a complicated market for that.
It is
all those equity compensations. So
yeah, terrific, Josh. Well, thank you so much, Josh, for the opportunity. It's been a lot of fun chatting with you. So.